Ever had that great business idea? The one that keeps you up at night. But then you hit that wall. Okay, how do I actually fund this? Or maybe you're running a business right now and you're thinking about growing, expanding. Where does that money come from? That's exactly where we're going today. We're diving deep into the world of business finance. Welcome to the deep dive. We've gathered a whole stack of your sources, articles, research, notes, all about how businesses get and manage their money. From, the tiny garage startup right up to the huge global players. And this deep dive, it's put together specifically for you to really cut through the jargon and give you the core insights.
Yeah, our mission here is really to pull out the most crucial bits of knowledge. Think of it as a shortcut, helping you understand the financial lifeblood of any business. We're not just listing funding types. We're digging into why certain choices make sense at different times. What's the strategy behind it all?
Exactly. We're basically mapping out the entire financial journey of a business, from those very first steps, maybe bootstrapped, right through to, the complexities of public markets. It's quite a ride. Okay, so let's unpack the beginning. Where does it usually start? A lot of businesses, maybe most, they start close to home, right? Funded by the owners, maybe family pitches in. Now, if you're, say, a sole trader, unincorporated, maybe the line between owner's capital and owner's loan feels a bit blurry, but, and this is important, if you incorporate, set up a proper company, that difference becomes really, really critical.
That's absolutely right. An owner's loan, that implies repayment down the line. Share capital, though, that's different. It's seen as permanent money. It stays in the business. It tells everyone, suppliers, banks, future investors, that the founders are serious. They got skin in the game. It provides a kind of foundational stability that loans just don't.
Okay, so owner funds, family funds. What happens when that's not enough? When you need to look outside, the options start opening up then, don't they? Even for a really new company.
They do. And it's fascinating, the variety that's actually available.
But what's realistic? Let's start with the banks. A bank loan or overdraft. Seems obvious, but maybe not easy for a startup.
Generally, no, it's tough. Banks are, risk-averse by nature. So for a new business without a track record, they'll absolutely want to see a solid business plan and definitely detailed cash flow forecasts. They need that reassurance.
And then there's the personal guarantee thing. That's the real kicker, isn't it? Limited liability is supposed to protect your personal assets, your house.
Right, but a personal guarantee, that essentially pierces that veil. You personally are on the hook if the business fails to repay. The bank can come after your personal wealth.
It completely bypasses that limited liability shield.
And overdrafts, while useful for short-term gaps, remember they're repayable on demand. Banks can, and sometimes do, pull them back, not just when things are bad, but when they think things might get bad. That's a risky position to rely on long-term.
Okay, so beyond the bank, what else? What about leasing or hire purchase instead of buying assets?
Yes. This can be quite a smart move. There are a few reasons why it might be cheaper than a bank loan. Firstly, big leasing companies buy assets in bulk. They get better prices than you or I could.
So they pass on some of that saving.
Potentially, yes. They're also really efficient at selling the assets at the end of the lease. Plus, their security is the asset itself. If you don't pay, they just take it back. It's cleaner. And often, their own cost of borrowing is lower because they're large, established firms. All that can make it more economical for the business leasing the asset.
And something maybe simpler. Trade credit. Just getting time to pay suppliers.
Absolutely. Don't underestimate this one. Typically, it's about 30 days. For a new business, that can be a lifesaver for managing cash flow day to day.
Do suppliers always ask for references?
Some do, especially for larger amounts. Yeah. But often, a supplier might give you a small credit limit to start, just based on trust, and build it up from there. It's really helpful.
What about help from the government? Are there government grants or loans readily available?
Direct government loans are actually pretty rare these days. The thinking is generally that financial institutions should do the direct lending, but loan guarantee schemes are much more common and quite important strategically.
Like the UK's Enterprise Finance Guarantee Scheme, the EFGS.
Exactly. That's a perfect example. Its whole point is to help banks lend to good, viable, small and medium businesses, SMEs, that just lack the security the bank would normally need.
So the government guarantees part of the loan to the bank.
That's the idea. But crucially, you, the business owner, are still 100% liable for repaying the whole loan. And you pay a premium for that guarantee. It's not free money, and it's not for businesses that aren't viable anyway.
Right. It's not a way to avoid putting up security if you actually have it.
Precisely. It's bridging a specific gap. In the UK, those EFGS loans run from about £1,000 up to £1 million for businesses turning over up to 25 million.
Okay, moving into slightly different territory. Venture capitalists and business angels. These sound more like partners.
You could say that. High-stakes partners, perhaps. These are usually wealthy individuals or firms investing in businesses they think have huge growth potential. And the key thing is they provide equity, private equity, not loans.
So they own a piece of the company.
Exactly. Their investment isn't secured on assets like a bank loan. They share the risk. If the business fails, their money could be gone.
And because that risk is so high, especially with early stage companies,
they expect very high returns. We're often talking in the region of 30% per year, typically realized when the company is sold or goes public.
And they usually want a decent chunk of ownership and maybe some control.
Typically, yes, maybe 25 to 49% equity. And they'll almost always want a seat on the board. Not to run the day-to-day usually, but definitely to monitor their investment, offer strategic guidance, and protect their interests. It's a very active investment.
What if your business is already up and running, sending out invoices but waiting to get paid? That cash flow lag can be killer.
It really can. That's where invoice discounting and factoring come in. Generally, you need a decent turnover, maybe around $200,000 or more, to make this viable. But the benefit is you can get cash off at about 80% of your invoice value almost immediately, sometimes within 24 hours.
And factoring specifically can involve more than just the cash advance, right?
Yes. Often the factoring company will actually manage your whole sales ledger for you, chasing payments, processing receipts.
Yeah.
It takes a load off your admin team.
But it costs, obviously.
Of course. There's an interest charge on the money advanced, usually similar to overdraft rates.
Yeah.
And then a fee for managing the ledger, maybe around 1% of your turnover. You can sometimes add credit insurance too for bad debts, though that costs extra. Otherwise, if your customer doesn't pay, you're still on the hook for that with the factor.
Okay, one last source, maybe the best one if you can get it. Retain profits.
Yes. But as you said, if you can't get it,
Right.
This is, well, obviously no good for a startup that's still making losses or just breaking even.
Right, it's for later down the line.
Exactly. But once a business is established and consistently profitable, retained profits become arguably the most important, most flexible source of finance. You're using the business's own success to fund its future, repaying debt, investing in growth, all without needing external approval. It's a sign of real health.
So we've got all these ways to get money, but how much does a business actually need? It seems like a simple question, but maybe it's not.
It's definitely not simple, and it's absolutely critical. You need capital for, well, three main things. One, investing in your non-current assets, the machines, the buildings, the things that help you make money. Two, covering those early periods when you might be making losses. You need a buffer. And three, and this is the one people often underestimate funding your current assets, inventory, receivables, the day-to-day stuff.
Which is where those cash flow forecasts become so important again, looking ahead.
Absolutely essential. You need to be looking 3, maybe even 5 years out to anticipate those needs properly.
And this connects to something you hear about overtrading. What exactly is that? It sounds almost like a good problem to have, being too busy.
It sounds good, but it can be incredibly dangerous. It's essentially trying to run before you can walk, financially speaking. Imagine you double your sales overnight. Great. But suddenly you need twice the inventory, you've got twice the receivables waiting to be paid.
And maybe you need to pay your suppliers faster or hire more people immediately.
Exactly. All that requires cash. If you haven't planned for that growth and raised enough permanent capital, you might find yourself desperately relying on a bigger overdraft just to fund those current assets.
And as we said, relying permanently on an overdraft is risky.
Very. A business in that situation should really be looking to raise more long-term capital to support that higher level of activity.
So once you've raised the capital, there's still the decision of how best to use it, investing in long-term assets versus managing the short-term stuff.
That's the ongoing balancing act. Investing in non-current assets builds your potential to earn profits. But you also need enough tied up in current assets, including just plain cash to keep things running smoothly, pay your bills.
But not too much, right? Because cash just sitting there isn't earning much, and too much stock costs money.
Precisely. Excess cash earns minimal interest. Too much inventory means storage costs, risk of damage, obsolescence. It's wasteful. So this leads to a really important strategic question. What's the right working capital policy for this business?
Right. You could be aggressive, keep working capital really lean, really low, or you could be conservative, hold more cash, more inventory just in case.
And the right choice really hinges on how predictable your cash flows are. If your income and outgoings are very stable, very predictable, maybe you can afford to be more aggressive. But if things are volatile, unpredictable. A more conservative approach, keeping a bigger buffer, is probably much wiser.
Is there a way to have access to emergency funds without actually holding loads of cash?
Yes, absolutely. That's where a line of credit comes in. It's basically a pre-agreed permission slip from a lender, usually a bank, saying you can borrow up to a certain amount on demand if you need it.
Like a business credit card almost.
In essence, yes. It's like your personal credit card. You hope you don't need to max it out on an emergency car repair, but it's reassuring to know the facility is there if you need immediate liquidity. You draw it down only when necessary.
This idea of timing leads us somewhere else interesting. Finance isn't all the same duration, is it? It comes in different time horizons.
That's a crucial distinction. We usually break it down into 3 categories. Short-term finance, that's generally anything up to about 2 years. Think overdrafts, trade credit, maybe factoring. Then medium-term, typically 2 years out to maybe 5 or 6 years. Term loans for specific equipment, lease finance often falls here. And finally, long-term finance. Anything over 5 or 6 years, right up to permanent capital, which is basically equity.
And there's a logic to which type you use for what, isn't there? The matching principle.
Exactly. It's fundamental. You match the length of the finance to the useful economic life of the asset you're funding.
Right.
We do it personally without even thinking, really. You wouldn't get a 2-year loan for a house.
No, you get a 25-year mortgage.
Right. And maybe a 3 or 5-year loan for a car, because that's roughly how long you expect to keep it or its main value lasts.
But maybe use a credit card for a holiday knowing you'll pay it off quickly.
Precisely. Short-term need, short-term finance. Long-term asset, long-term finance.
So applying that to a business, premises, big machinery that needs long-term funding.
Definitely. Long-term equity, maybe bonds if it's a larger company, or long-term loans over at least 5 years.
What about things like delivery vans or standard equipment?
That might be medium-term. So equity or bonds could still work, but also medium-term loans or quite commonly lease finance over 3 to 5 years.
And the really short life stuff, inventory, receivables.
Okay, here's a slight nuance. While individual items of stock turn over quickly, a business usually needs to hold a certain base level of inventory and receivables pretty much permanently, that permanent base level. That should ideally be funded by long-term capital. Then the seasonal peaks, the fluctuations above that base level, that's where your short-term finance comes in overdrafts, factoring, trade credit.
So you're matching the permanent need with permanent capital and the temporary need with temporary capital.
That's the ideal. The problem with relying too heavily on short-term finance for everything is that it constantly needs renewing, renegotiating. It creates uncertainty.
Yeah.
Long-term capital provides that stability.
Okay, let's shift gears. Fast forward. Imagine a company's been around a while. It's profitable. It's grown quite a bit. What new financing doors open up then?
Well, this is where things get really interesting, potentially moving into the public markets. We're talking public equity and public debt.
Public equity. So listing shares on a stock exchange.
Exactly. Making shares available for the general public or large institutions to buy and sell. And different exchanges cater to different types of companies. You've got, say, the London Stock Exchange with its main market for the big established firms, but also AIM, the alternative investment market, specifically designed for smaller, growing companies.
Less stringent requirements for AIM.
Generally, yes. Things like trading history requirements might be lower or non-existent compared to the main market. Similar structures exist elsewhere, like NASDAQ in the US having different tiers. It allows companies at various stages to access public equity.
And that first time a company offers shares to the public, that's the big IPO, the initial public offering.
That's the one. It's a huge step. Requires a massive document called a prospectus.
Lays everything bare, right? Finances, business model, risks, management.
Everything. Total transparency is required. And then you have different ways to actually do the listing.
Oh, it's not just one way.
No, there are choices, depending on the company's situation and goals. You could do an offer for sale at a fixed price, straight to the public. Or an offer for sale by tender, where investors bid, which can help gauge demand. There's also a placing, often quicker and cheaper, where shares are offered mainly to big institutional investors.
So not really for the general public directly.
Not usually, no. And then, very rarely, you might see an introduction, where shares that are already widely held just get listed, but no new money is raised. Each method has its pros and cons regarding cost, speed, and who you reach.
And after the IPO, if a company wants to raise more equity later,
That's typically done through a rights issue. Existing shareholders get the right to buy new shares, usually in proportion to how many they already hold.
and they're offered cheaper than the current market price.
Yes, typically offered at a discount to make it attractive. But theoretically, because existing shareholders get these rights, they aren't really better or worse off financially overall. If they take up the rights, they invest more cash but maintain their percentage stake. If they sell the rights, they get cash, but their stake is diluted. The company gets the new capital it needs.
The big plus of listing is obviously tapping into potentially huge amounts of capital. What's the downside?
The main one is scrutiny. Suddenly you're under the microscope. Quarterly reports, analyst calls, media commentary. You have responsibilities to a wide range of public shareholders.
And founders sometimes hate that, losing that total control.
Oh, absolutely. Giving up that autonomy, having to answer to outsiders. It can be a real culture shock after running your own show for years. It's a major trade-off for the access to capital.
Okay, what about the other side of public markets? Public debt.
Right. This basically means issuing bonds, sometimes called loan notes, that are quoted and traded on an exchange, just like shares. These bonds typically pay a fixed rate of interest, the coupon rate. Their market price can go up and down depending on interest rate movements and the company's perceived risk.
Are they usually secured?
Often, yes, with fixed or floating charges over the company's assets, which makes them safer for investors. They're usually redeemable, meaning the company pays the face value back at a set date, though occasionally you see irredeemable ones.
And how does the cost compare to equity?
Generally, much cheaper for the company, especially if the bonds are well secured and the company isn't overloaded with debt already, what we call being highly geared. Lower risk for the investor means they demand a lower return. Plus, and this is key, the interest payments the company makes on the debt are usually tax deductible. That reduces the effective cost even further. So for mature companies, it's often a very cost-effective way to raise large sums.
Now, you mentioned something earlier, convertible bonds. These sound like a hybrid, a clever device.
They are quite clever and very useful, especially for maybe younger, growing public companies. They basically offer investors a sort of wait-and-see option. They start life as straightforward debt, paying regular interest, which is less risky for the investor than jumping straight into equity in a company that might still be proving itself.
So the investor gets the safety of debt initially.
Right. But the convertible part gives them the option to swap their bonds for a predetermined number of the company's shares at some point in the future.
So if the company does really well and the share price rockets,
The investor can convert their safe bond into growth potential shares and benefit from that upside. If the company doesn't do well, they can just stick with the bond and get their capital back at maturity.
best of both worlds for the investor, potentially. What's the benefit for the company?
Because they're offering that potential equity upside via the conversion option, the company can usually get away with offering a lower interest rate on the convertible bond than they'd have to pay on a straight non-convertible bond. It lowers their initial financing cost.
Okay, wrapping things up, a final big strategic thought for companies. Gearing. We touched on it, but let's talk about that balance and the cost of finance.
Yeah, this is crucial. Companies are always thinking about their weighted average cost of capital, or WACC. What's the overall cost of their funding mix? And maybe counterintuitively, having some debt in the mix can actually lower that average cost.
Because debt is generally cheaper than equity.
Exactly. Equity is high cost because shareholders demand a high return for taking the ultimate risk they're last in line if things go wrong. Debt is lower risk for the lender. They get paid first, often have security, so they demand a lower return. Plus, as we said, the interest is often tax deductible for the company.
So starting with zero debt, adding some debt pulls the average cost down, finding that sweet spot.
Precisely. There's usually an optimal level of gearing the ratio of debt to equity where the average cost of capital is minimized.
But you can overdo it. Too much debt is bad.
Oh, definitely. Too much of a good thing. If gearing gets very high, the company starts to look much riskier. The risk of default, not being able to meet those debt payments, goes way up.
And that makes everyone nervous.
It does. Lenders will start demanding much higher interest rates on any new debt to compensate for that extra risk. And even equity holders get nervous because the risk to their investment also increases dramatically. So the cost of equity goes up too.
So the average cost of capital, which was falling, starts to rise again if you borrow too much.
Exactly. It creates a sort of U-shaped curve. There's an optimal point. Now, some financial theorists, like Modigliani and Miller, famously argued that in a perfect world with no taxes or bankruptcy costs, capital structure wouldn't matter.
But we don't live in that perfect world.
We certainly don't. Taxes and the real costs associated with financial distress mean that, in practice, capital structure does matter, and finding that optimal gearing level is a key financial strategy.
Wow. Okay. What a journey we've taken there. From, borrowing a few quid from your uncle right through to convertible bonds and optimal gearing ratios on the public markets.
It really covers the spectrum, doesn't it? And I think the key takeaway connecting it all is that financing a business isn't a one-off event. It's not just get the money. It's an ongoing, dynamic process. The right choices evolve as the business itself evolves its size, its profitability, its risks, its ambitions.
Absolutely. So thinking about how vital capital is, here's something for you to chew on. Beyond just funding things, how does a company's chosen financial structure, its mix of debt and equity, its use of short-term versus long-term finance, how does that actually reflect its deeper attitude, its appetite for risk, its fundamental long-term vision? And maybe could that matching principle we talked about for physical assets, could you apply it to less tangible things, like how do you best finance investment in your brand or in R&D? Does the type of capital influence the type of investment? Something to think about.